Hi, I'm Seth Freudberg. I'm the Director of Options Training here at SMBU in New York and head of SMB's Options Trading Desk. I'd like to talk today a little bit about a dopey thing that people say in the options world. That it's sort of a myth, and it's a really dangerous myth that I would like to dispel so that people don't get themselves into trouble. And it's called the concept of financing an options purchase. So let me start out by saying that I used to be in the insurance business. I used to run a property and casualty insurance company, and we would insure homes, for example, homeowners insurance. Wouldn't you find it a little odd if someone who wanted to buy a homeowner's policy for, let's say they owned $1 million home, and they were going to pay $2,000 a year for the insurance on that home? That might be a reasonable price for a homeowner's policy. And so they said, hey, you know what, this year I don't really feel like paying for my homeowner's insurance, so I'm going to go out and actually insure two other people with $500,000 houses, and I'll get $1,000 from each of those guys. I'll take the $2,000 and turn it over to my insurance company, and then I've just financed my homeowner's policy. I just have my homeowner's policy for free, right? Well, there's an obvious flaw in that concept, and that is, yes, you got $2,000 in premium from your buddies, and you went and paid it to your insurance company, so you had no net cost to your homeowner's insurance. However, what if one of your friend's houses burns down? All right? Suddenly you owe him $500,000. And so you could say you financed your homeowner's insurance, but that would be sort of ridiculous, right? What you did was you paid for something that bought you protection, but then you entered into an obligation that was extremely serious and extremely dangerous. Well, people in the options world actually think that way, and it's a very foolish way to think. Let's take a look at a vivid example of this. So everyone will remember, it was only a couple weeks ago now, August 24th, there was a gap crash or flash crash that occurred in the market. The Friday before, you can almost forget, was actually a very serious down day in the market. The SPX index was off about 50 points that day. That's a big down day on the S&P 500. So let's say on that day you said, you know what, I feel like the market is getting ready to really tube, so I am going to buy an at-the-money put on the S&P 500 index at 1980, which is roughly where the market closed. It actually closed a little bit lower than that, but let's say you were doing that at 3:30 when it was around 1980. So you were worried the market was going to sell off further, and you thought you'd make some profit from that by buying a put. Well, you then said to yourself, but you know what, I don't feel like paying anything for that opportunity, so I think I'll go down to the 1900 strike and sell two of those puts, and I'll receive a credit for that, and I will buy therefore the 1980 option that I bought, I don't have to pay any money for. So if the market goes down, I'm going to make all this money. Does this sound familiar? Well, that's kind of the same thing as my hypothetical person who didn't feel like paying for his homeowner's insurance. All right, so let's now take a look at 3:30. I won't even make it as ugly as it could have been by showing you the chart on the first thing in the morning. Let's look at 3:30 on August 24th. All right, on August 24th now, your very bright idea when the S&P was now down below the short strikes, those short puts. So you made a great deal of money on the long put you bought. Congratulations on that. However, you lost more than you made on the long put by selling those two short puts that were making that a free transaction, you thought. Well, it wasn't free. You were taking on substantial risk, and you didn't think about that risk until the market crashed that morning. So your great idea, you were actually right, the market went down, but because you structured your trade in a reckless manner, you ended up losing $3,400 roughly, as you can see here on this matrix. And not only that, but your original margin, which was about $24,000, went up 50% because you had a naked option past. You were naked one option because you had more short options than you had long options. So the bottom line of the story is that you should never think of entering into short options as a way of financing a long option. It's a very dangerous way to think. If you try to finance something, the market is not going to give you these things for free. If you are short an option, you have an obligation. It may be able to give you the cash flow to buy a long option and then some. In this case, you were actually receiving a credit, but the downside is enormous. In fact, I'd like you to take a look at this graphic here. If the market had kept going, you could have been out $100,000. So if it had sold off far enough. And so therefore, and it's not like the market never crashes. It happened in 2008, and it's going to happen again one day. That we saw a little mini version of it on August 24th. One day there will be something much bigger, most likely. So you need to understand that you are never financing a long option with a short option. What you're doing is you're really entering into an obligation whenever you are naked a short option, and that obligation can be extremely dangerous. So take that vocabulary out of your mind. Don't talk about financing an option. What you're doing is you are giving yourself a cash flow, a short-term cash flow advantage, and you're selling your soul basically by entering into a very, very dangerous transaction which could wipe you out theoretically. So get that word out of your mind. Don't think of yourself as financing options. Stop getting mixed up between risk and cash flow and enter into safe transactions. One of the best ways to do that is to always have a long option and a short option matching that, so that you never have a greater number of short options than long options. If you have that, you can't get into an unlimited risk situation like you would have put yourself in had you done this ratio spread on August 21st. So don't fall into this trap. Don't think about financing options. Think about structuring transactions that have safe, fundamental risk management to them, and that's how you'll survive and prosper as a trader. Thanks very much, and we'll see you next week.